Warren Buffett's wealth story sounds fake when you say it out loud. Turn $1,000 into $165 billion. No viral startup, no crypto miracle, no Silicon Valley lottery ticket, just stocks, businesses, time, and somehow that makes the story harder to believe, because if the secret were complicated, we could dismiss it. If it required genius-level math or insider access, we could opt out. But Buffett's strategy was painfully simple, and that's what makes it uncomfortable. This isn't a story about speed, it's a story about patience, weaponized over decades. Chapter 1. The $1,000 that started a snowball. The $1,000 headline isn't meant to be taken literally, and that's exactly why it matters. It's shorthand for something much more powerful, small capital, deployed early, with intention. Warren Buffett didn't begin life with wealth. He didn't inherit millions. There was no trust fund waiting in the background. What he had instead was something far rarer, clarity at a young age about what money actually was. To Buffett, money wasn't status, it wasn't freedom, it wasn't even security, it was a tool. At just 11 years old, Buffett made his first stock purchase, 3 shares of Citi Service Preferred. He bought, waited, got impatient, sold, and then watched the stock climb higher without him. For most kids, that would have been a forgettable moment. For Buffett, it became a scar. He later said that experience taught him a lesson he never forgot. The cost of impatience is invisible, but enormous. That single mistake shaped decades of behavior that followed. By 13, while most kids were worried about homework, Buffett was filing his first tax return, deducting his bicycle as a business expense for his newspaper route. This wasn't cleverness, it was seriousness. He wasn't playing entrepreneur. He was acting like one. At 14, Buffett took his savings and bought a 40-acre farm in Nebraska. Not because farmland was trendy, not because someone told him to diversify, but because he understood something fundamental. Assets that produce income are worth more than money that just sits still. By 16, Buffett had accumulated roughly $53,000. In the 1940s, adjusted for inflation, that's well over $500,000 today, earned before most people get their first job. But here's the most important part. This wasn't luck. Buffett wasn't guessing, he wasn't gambling, he was systematically stacking small wins, reinvesting everything, and learning obsessively along the way. While other kids memorized sports stats, Buffett memorized stock tables. While others spent money, he studied how to make it multiply. He treated money the way engineers treat machines, something to be understood, optimized, and respected. And once Buffett cracked the code early, he never stopped playing the game. That early $1,000 didn't turn into billions overnight. It rolled slowly, quietly, relentlessly, like a snowball at the top of a very long hill. Chapter 2. Buffett's real advantage wasn't intelligence. People love calling Buffett a genius. He's smart, but intelligence alone doesn't turn $1,000 into $165 billion. His real edge was something far rarer, time plus consistency. Buffett began compounding capital earlier than almost anyone, and he compounded longer than almost anyone. Here's a stat that reframes everything. 99% of Buffett's net worth came after age 50, over 90% came after age 60. Let that sink in. The man most people call overnight successful didn't become really rich until most people are thinking about retirement. Buffett once said, "If you start early and live modestly, you don't have to do anything extraordinary." That sentence quietly dismantles most modern wealth advice. Chapter 3. Learning before earning. Before Warren Buffett ever earned serious money, he made a decision that quietly separated him from almost everyone else. He chose to learn before he chose to earn. Most people chase income first and education second, if at all. Buffett reversed that order, and the payoff would compound for the rest of his life. As a teenager in Omaha, Buffett wasn't interested in trends or popularity. He was interested in systems. He wanted to understand why money behaved the way it did, why markets rose and fell, and why some people consistently won while others didn't. So he read constantly. He worked his way through every investing book in the local library, many of them multiple times. But one book stood above all the rest, The Intelligent Investor by Benjamin Graham. That book didn't just influence Buffett, it reprogrammed him. Graham introduced an idea that was radical at the time and still uncomfortable today. The market is driven by emotion, not logic. Fear and greed push prices far away from underlying value, creating opportunities for those patient enough to wait. Graham famously described the stock market this way: "In the short run, the market is a voting machine. In the long run, it is a weighing machine." What he meant was simple but profound. In the short term, stocks move based on popularity, headlines, and speculation. But over time, reality asserts itself. Profits matter. Cash flow matters. Businesses are eventually valued for what they actually produce. For Buffett, this was a revelation. He realized he didn't need to predict the future. He didn't need to be faster than Wall Street or smarter than everyone else. He just needed to be more disciplined. So when Buffett applied to Columbia Business School, it wasn't for the prestige. It was for one reason only. Benjamin Graham taught there. At Columbia, Buffett sat in Graham's classroom like a disciple. He absorbed the principles of value investing, buying assets for less than their worth, demanding a margin of safety, and avoiding unnecessary risk. These weren't flashy ideas, they were conservative, almost boring, but they worked. More importantly, they aligned perfectly with Buffett's temperament. He wasn't impulsive, he wasn't emotional, he was methodical. Graham's framework gave him permission to lean into those traits rather than fight them. This philosophy would shape every major decision Buffett made for the next 70 years. He wasn't trying to forecast earnings decades into the future. He wasn't guessing which industry would be hot next year. Buffett's primary goal was much simpler and much harder. Don't lose money. Chapter 4, The First Million, Skill Without Scale. Buffett's first million didn't come from Berkshire Hathaway. It came from investment partnerships he ran in his 20s and 30s. Between 1956 and 1969, Buffett averaged returns of roughly 29% annually, while the broader market returned around 7–10%. By age 30, his net worth was about $1 million. By 35, it was closer to $7 million. Adjusted for inflation, he was already extremely wealthy. But here's the key detail most people miss. Buffett wasn't optimizing for lifestyle. He was optimizing for capital efficiency. Every dollar was a soldier, not a souvenir. Chapter 5, Berkshire Hathaway, a bad business, a great vehicle. Berkshire Hathaway began as a mistake. It was a struggling textile company. Buffett bought it because it was cheap, not because it was good. Later, he admitted, "I was so busy being smart that I forgot to be wise." So how did a failing textile company become one of the most valuable corporations on earth? Buffett repurposed it. Instead of fixing the textiles, he used Berkshire as a capital allocation machine, a place to funnel profits into better businesses. This decision changed everything. Chapter 6, Owning Cash Machines, Not Stocks. Buffett's wealth didn't come from trading stocks. It came from owning businesses that printed cash year after year. Some cornerstone investments: Coca-Cola, bought heavily in the late 1980s, American Express, held through major scandals, Geico, fully acquired Apple, eventually became Berkshire's largest holding. These weren't hype-driven bets. They were companies with durable brands, pricing power, predictable cash flow, long runways for growth. Buffett didn't need perfection. He needed reliability. Chapter 7, The Snowball Effect in Action. Buffett compares wealth to a snowball rolling downhill. Early on, it barely moves. You're investing, saving, learning, and it feels like nothing is happening. But once the snowball gets big enough, gravity takes over. This is why Buffett's wealth curve looks flat for decades, and then explodes vertically. Compounding doesn't show up early, it shows up late. And when it does, it's unstoppable. Chapter 8, What Buffett Refused to Do. Equally important are the things Buffett didn't do. He avoided excessive debt. He ignored market hype. He didn't chase trends. He rarely sold winning businesses. His favorite holding period? Forever. In a world addicted to motion, Buffett mastered stillness. Chapter 9, Lifestyle Discipline, The Silent Multiplier. Buffett still lives in the same Omaha house he bought in 1958 for $31,500. No mansions, no super yachts, no billionaire cosplay. Why does this matter? Because money not spent is money that compounds. Buffett reinvested what others consumed. Over decades, that difference became billions. Chapter 10, $165 billion, and giving it away. Today, Buffett's net worth is around $165 billion, but he has pledged to give away over 99% of it. Why? Because the point was never the money, the point was the process. A system built on long-term thinking, rational behavior, patience under pressure. Buffett didn't win by being extraordinary every day. He won by being consistently reasonable for an extraordinarily long time. The real lesson isn't buy stocks, it's this. Wealth isn't built by intensity, it's built by duration. Buffett didn't turn $1,000 into $165 billion by being flashy. He did it by staying in the game long after everyone else quit. If this story helped shift how you think about money, like the video, subscribe to the channel, and drop a comment below on which investor or business story you want broken down next.